Liz, we've seen a pretty decent rally, although maybe not for this week. Week to date, we're down still. We're looking at some green arrows this morning. You think, though, this rally is going to run out of steam soon. Why is that?
Well, if we look at the amount that we've risen over the last month and a half or so, we're up 10% since the end of September. That's a pretty big jump. And look, bear market rallies can be really powerful. I think that if this turns out to be one, this is no exception. But when you look at valuations, and this year has been a valuation story, absolutely. When you look at valuations, the S&P is trading now at 17.3 times forward earnings. That is higher than the 5, the 10, and the 15-year average. We know that over the 10 and 15-year period, most of that time has been spent at zero rates, but it just doesn't feel right for the S&P to be trading at that level in a time when we've really just started to hear about earnings contractions and layoffs. So I would expect that we probably give some of that back. But the good news is, if we do have another pullback in the market, I think it's the last one.
Why?
Because we've now seen a lot of the economic data start to crack. And when you think about the timing of how things usually work, the market typically falls before the economy really bottoms. What we need to see is that economic data come down enough that the Fed gets comfortable with the idea that inflation will actually be taken care of. I think what we don't want to see, and the biggest risk that investors are hoping for, I think, is that the Fed pivots too early. That would be a bad thing, and we'd have to clean up for it much later on, and it becomes a much bigger problem. So as the economic data softens further and we start to really come to grips with the fact that a recession is likely in 2023, that's when the market gives its one last breath and says, okay, we have to regulate where we are with valuations, and we have to set our expectations properly for next year.
Did you see the Goldman Sachs call that Steve Leisman was just talking about, that they think we could actually narrowly avoid a recession next year?
Look, anything could happen, right? Crazier things could happen. But when you look at just the signals, not only the signals that the market is giving us with a yield curve at its deepest inversion since 1981, we've got economic data, leading indicators saying things like new orders are contracting, small business optimism down back to COVID lows, and now we've got capacity utilization turning down. All of those things would point to the idea that there probably is going to be a recession. That doesn't mean it has to be terrible. That does not mean it has to be deep or long. All it needs to do is reset the business cycle. And really, at this point, if that recession is contained to only certain sectors, some of the ones that have felt most of the pain, tech being one of those, then it doesn't even necessarily have to hit all corners of the economy. We might not feel it that deeply, and we won't know about it until it's over. So I actually would welcome some pullback in GDP. I would welcome a reset in the economic cycle, especially one that takes care of inflation, because then we can start on the other side with more of a clean slate.